Bloomberg Audio Studios.
Podcasts, radio, news.
We need some perspective on this market in a big way with some of those futures readings that Lisa was just reporting. And for that, we go to the lawn in Charlottesville, Virginia. Lori Calvasina, head of U.S. Equity Strategy, RBC Capital Markets. If you know what that means, you know. Lori, what do you make of the last couple of trading days here in the futures market here today? The market kind of turned on a dime there on that jobs number.
It did. Look, I think the biggest takeaway we have right now is people like Tom Keene going on vacation. I think everyone's going to be afraid to take vacation in August now. But I think the reality is that we have to take the last couple days in context. And that's what we really tried to remind people of in our weekly this morning. We're not sitting here saying recession fears didn't escalate, that there weren't some, signals in the jobs report and the ISM report on Thursday. But we do think people need to bear in mind that we had, I think I came up with like 6 or 7 different reasons that markets should be selling off right now. This includes valuations that were full, a tendency for the stock market to sell off after first rate cuts occur, so maybe we're pulling that forward. We had extremely elevated positioning on the CFTC data for U.S. equity futures, NASDAQ futures, S&P futures. AAII was sending us a sell signal the last couple weeks. We've got the election where dynamics are shifting. That typically produces a pullback in September. Again, maybe we're pulling that up. And by the way, markets have been correlated with Trump, and now he's lagging behind Harris. So there's a lot of stuff going on. And by the way, add the fact that seasonality the last 5 years has been really, really poor time to be in the stock market, August through October, I think including specifically 2022 and 2023. So there have been a lot of reasons this market has needed to take a bit of a pullback in here.
So Lori, it's Alix, and I love reading all your notes. It's like first must read on Monday, got to set you up, right? When does, though, a healthy correction become an unhealthy one?
So I think the biggest thing I'm worried about in here, and I'm trying to tell everybody, keep a calm head today. I do think we need to dig into the BLS report a bit more, find out exactly what the weather impact was there. But I do think that the rule of thumb I always use is 5 to 10% is a typical correction if you look from peak. So that would kind of take us down to sort of the 5,100 marks. We have to watch markets closely in here. If you look at sort of the 10 to 20% range, that's typically, in the post-GFC world where the growth scares settle in. Now, 2022 was a little bit different. It wasn't a recession. We fell 25%. But generally, anything more than 20% is an actual recession. And I think one of the reasons why it's so jarring, kind of the move from Wednesday to Thursday, Friday, is that if you go back to corporate earnings and equity investors, we've all had our heads stuck in these corporate reports the last couple of weeks. What we're seeing in that jobs data, it's not really syncing up with what we're hearing from companies right now. So I do think we need to sort of take it one step at a time in here.
Lori, what do you think the Federal Reserve is going to do here? There was some discussion over the weekend, maybe an emergency rate cut. What do you think they're going to do here?
So I have no idea. I think we have to talk to the rates crowd. We have to talk to some of the reporters. But the truth is, I don't. And I get a little bit frustrated with the Fed guessing game that people play on Wall Street all the time. I think they're looking at data. They're trying to make the best decisions that they can. But what I can tell you is this question has come up a few times since Friday, and even frankly since the CPI report. That's when my rate strategist was telling me he was first getting questions about 50 basis points. And I kind of went and dug up some of my work from SVB, looked through some of my files, and we found that in at least kind of my time on Wall Street, I started in 2000, when you either get sort of the big chunky cuts or you get the emergency cuts, generally they don't tend to happen in isolation. They tend to happen in bunches. So I worry a little bit that if we get some sort of emergency action, if we get some sort of big chunky cut, it could further spook the market. That's just my opinion, though. There are certainly people out there smarter on this than me.
No, I mean, it's a fair point. And there are a lot of people out there who trade equities who are in kind of your boat, right? So based on all of that, when and where do you buy the dip?
So I think we've got to take it one day at a time. I want to see sort of how the market reacts if we get down to that 10% threshold. I think that's sort of where we could look to see if there's a line in the sand. The other thing that's come up a bit this morning is just, sort of looking at valuations. We've been very elevated, for example, on those top 10 names in the broader market. In the S&P, you've been trading. You got up to 32 times on a median PE, actually. It's now fallen down as of last Wednesday to around 27. Who knows where it is today? We'll see tomorrow. But I do think you want to sort of watch for some additional relief on those valuations. And I've noticed just in my career, a lot of times you don't have to get super cheap on things for the bleeding to stop. Sometimes you just need to go get back to average, get a little bit below average. Small caps, for example, is the opposite phenomenon right now. They keep getting up to average, and then the trade sort of peters out. So I think watching when we get back to average valuations on certain things is going to be critical.
So, Lori, I'm just looking at NVIDIA here in pre-market trading. The levels suggest a 30% pullback from its recent high.
Wow.
I mean, that gets your attention. I mean, if you told somebody you could buy, I'll give you NVIDIA at a 30% discount to its high, if you said that to them on Thursday, I think they'd grab it both hands. What do you think about some of these big tech names that have led the market higher and which are now taking the big brunt?
So when I think about the basket as a whole, I think that we've sort of hit a valuation ceiling. I mentioned, we kind of got up to 32 times on those top 10 names on a median PE. When it's hit sort of, the upper 20s, 30 in the past, that's really been the ceiling. So I think we kind of hit the ceiling on valuations. If you look at the growth rates on the Mag 7 versus the rest of the market, we've had a decelerating growth advantage. And so, those Mag 7 names had just ferocious earnings growth last year, but it's expected to decelerate both this year and next. It's hard to sustain the premium valuations when you've got a growth rate that's accelerating off peak, even if everything is fine. Mm-hmm. So I do think the valuations are really the key to the story here. We just need to see some additional relief.
The VIX has jumped an insane amount in 2 days. The curve is super inverted at this point. What kind of damage does a VIX that's moved the most in 30 years do to the equity market?
So look, I think it's a question of where does it settle out? I actually called someone this morning. I got to the office pretty early and it was around 50, and I called someone to say, is this real? Is this actually the real data point? So I'm glad you guys are reporting it as well. But I think the reality is it just tells me that we have a sentiment problem in the market. That sentiment needs to unwind. I mean, if you look at the CFTC data, Alix, the broader U.S. equity futures positioning across all of the buy side, so we add up 3 different categories together, it's been sitting above January 2018 levels. It's been sitting above February 2020 levels, and also above the levels of 2021, 2022, though frankly, those weren't nearly as high as what we saw back in the 2018 and 2020 timeframe. So there has just been, I don't think people necessarily have sounded rah-rah when you've talked to them, but if you've looked at the actual positioning data in the futures market, these are some of the levels that have historically just caused a tremendous amount of volatility, and we need to let that play out in here.
All right, Lori Calvasina, thank you so much for joining us. We know you're super busy today. Lori Calvasina, she's head of U.S. Equity Strategy at RBC Capital Markets.